Welcome back. Glad to have you back on this week's market update by me, T, your neighborhood realtor. This week we will be discussing interest rates. Now last week we talked about affordability and how homes aren't unaffordable but less affordable, as what it has been in recent history. Interest rates are rising, and when it does, it causes concern for buyers and for those in the market. The two biggest issues are interest rate and inflation. Now, as they rise, they become issues as well as concern for buyers and sellers. We want to have the best answers in the market for you. So, although we started the year around 3% to 3.1%, according to Freddie Mac, the weekly interest rate monitor, and looking at the graph, the average 30-year fix is 3.5% as of today. Many people average or monitor the 30-year fix numerous ways, so it varies. I personally use Freddie Mac. But the bottom line is, prices for financing a home is going up. Now, according to chief economists, mortgage rates moved up again as the 10-year Treasury yield rose and financial markets adjusted to anticipated changes in monetary policy that will combat inflation. As a result of higher mortgage rates, purchase demand has modestly waned in advance of the spring home buying season. However, supply remains near historically tight levels and home prices remain high, keeping the market competitive. So looking at the graph, if you were to say draw a line right now to way back to 2018 at 3.56%, we are actually back to where we were before the pandemic. For the last decade, we are going back to 2010. We hovered between 3.5% to 5%. So in essence, we are going right back to where we were. Shan Carter stated, and I quote, "As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive." Now, in 2022, we expect purchase originations to grow from $1.9 trillion in 2021 to $2.1 trillion in 2022, while refinance activity is anticipated to decrease from $2.7 trillion in 2021 to $1.2 trillion in 2022. So what he's saying is that we are going to sell more homes in 2022 than we did in 2021. So purchase demand is going to grow. So many consumers hear about the mortgage origination constricting, but what they don't know is that it's all due to refinance volume, not purchase volume. Why? Because everyone refinanced 2.5%, 3%, 3.5%, the list goes on. Now, untreated rates are rising, whereas purchase volume is forecasted to grow this year over last year. So comparing this rate to the last 5 years, we are still really, really good for the average 30-year fix. In the decades of 2010, the rates were 4.9%. So buyers are still in a really good market for financing. I say this because if we look back over the history of mortgage rates, as well as averages, we are still in a good position right now. The 10-year Treasury yield is skyrocketing, going back to approximately 2 months ago. The 10-year Treasury is going up. So for almost 50 years, the 30-year mortgage rate has moved in unison with the 10-year Treasury rate. Joe Kahn stated that mortgage rates hit their highest level since March 2022, leading to the slowest pace of refinance activity in over 2 years. I brought this up because it ties into what we were discussing earlier about the forecast, the restrictions, and the refinance activity. So if you're thinking about buying a home, take the first step and get a pre-approval. Well, that will wrap it up for this week's market update. Like I always say, my goal is to help you create wealth and purpose in this thing we call life, as well as feel free to like, comment, share, subscribe for more updates on the real estate market. See you next week.